Um, so because we will be working with a lot of information for the year when the project will begin and all the way through the final year of the project, we need to first know how to identify what's relevant and what's irrelevant. Irrelevant means we can ignore those dollar amounts. We can cross them out. They are not going to be used in our net present value calculations. So here I have a few examples. Taxes, lost revenues from existing projects, wages to employees, depreciation expense, money paid to consultants, initial purchase price, interest payments on debt. So these are not, the only type of cash flows we will be working with. This is just an example, like a small set of all the information for a project. Turns out some of these are actually called irrelevant to project valuation, which means we don't need to worry about them. We can cross them out and forget about them. We will not use them in our NPV calculations. So which are relevant and which are irrelevant? That's the topic on the next couple of slides. Taxes, they are very important. We must pay taxes on our corporate income. Wages to employees, without employing people, we will not be able to produce the product that we are planning to sell, in this project. Lost revenues from existing projects, well, if by implementing some new project, we are going to see lost sales from something else we already have, that's an important, consideration, right? So this is also a relevant type cash flow. Depreciation, initial purchase price, interest payments on debt, money paid to consultants. So let me just speed it up a little bit and say that among these 1, 2, 3, 4, 5, 6, 7 examples, there are 2 which are irrelevant. And these 2 are money paid to consultants and interest payments on debt. It might look strange why this would be unimportant. So money paid to consultants, paid, right? This verb is in the past. This is the money that has already been paid before we are making our decision to accept or reject the project, right? So it's not like if we decide to reject this project because the NPV is negative, we would then come back to our consultants that we were working on some, maybe market analysis related to this project and ask them to pay us the money back, right? This money will not be recovered anymore, whether the project is accepted or rejected. And because it already occurred in the past and cannot be recovered, we call it a sunk cost. So money paid to consultants is an example of what we call a sunk cost. And sunk costs are irrelevant to project valuation. So if there is something that looks like money that has already been spent in the past before the decision on the project is made, then you should cross that number out from your list, and you will not be using it anywhere in your net present value calculations. Now, why are interest payments on debt also considered irrelevant? I would say there are a couple of ways to explain it. First, interest payments on debt are financing expenses. They are not so-called operating expenses, which are necessary to produce the product. Interest payments on debt, like making payments on a loan, right? And maybe we took a loan to cover part of the initial cost, like buying any sort of furniture or equipment or buildings, right? So why are interest payments considered irrelevant? Another reason is, other than being sort of a different category of cash flows, not operating but financing, you can also say that taking a loan is kind of an optional thing. If the company had money, it would not need to take a loan, right? And in that case, what would the cash flows that are, really required for the project, and exclude any sort of interest payments that are kind of not very necessary? What would the cash flows then tell us about the acceptability of this project? So interest payments on debt and the money that has already been paid, like paid to consultants or maybe research and development, are the two cash flows that we are going to treat as irrelevant to project valuation. Another way you can explain what relevance refers to is you can say that relevant cash flows are incremental cash flows. The word incremental means additional. Additional to what? Additional to a firm's existing cash flows, right? So incremental or relevant cash flows are cash flows that are incremental to a firm's existing cash flows, right? On other projects that it already has running, and that are a direct consequence of taking this project. You can also say that incremental cash flows will only occur if the project is accepted. Incremental cash flows should be included in a capital budgeting analysis. In other words, in calculating the net present value for some investment opportunity. There's also another, little topic that's related to cash flows being relevant or not, called the stand-alone principle. What this means is we need to be analyzing each project in isolation from the firm simply by focusing on these incremental cash flows. In other words, imagine we have a restaurant chain. It currently has 10 restaurants, right? And it's now considering whether it should open one more restaurant in the area, the 11th one. So rather than calculating the net present value from all future, cash flows coming from all 11 restaurants and comparing that to the net present value coming from, revenues from the current 10 restaurants, we should instead look at the 11th restaurant only, kind of isolated from everything else, unless of course it has some impact on our existing restaurants. So maybe by opening the 11th restaurant, we are going to lose some sales from another restaurant that's close, the closest to it, something that also belongs to us, right? Then the 11th restaurant has, this negative impact on the sales from one of our currently operating restaurants, and that part would need to be considered. Okay, so in this table here, I kind of tried to summarize, different terms used for different types of cash flows. The first two rows include sunk costs and financing costs. And these are the two cash flows that I put no for in the last column in this table. No means not relevant, right? So sunk costs are those expenses that have already occurred. They're not recoverable even if the project is rejected. An example includes money paid to a consulting firm to do some sort of preliminary, maybe data collection, data gathering and analysis, research and development, R&D, and so on. Then second, financing costs, also treated as irrelevant. That's essentially anything related to taking a loan and paying back to the lender. So interest expenses. We are going to ignore them. Right, so if we decided to take a loan or sell bonds to borrow money for our new project, then these are the kind of numbers that would be ignored in our net present value calculation. Then I have side effects, also known as spillover effects or project externalities. There are two types of side effects: a negative effect on a firm's existing product is called erosion. A positive effect on a firm's existing project or product is called synergy. Let me give an example. So let's say 10 years ago, roughly, when Apple was, considering selling iPhones for the first time, right? I'm pretty sure Apple was realizing that when iPhones would start selling, iPod sales would drop, right? So there will be less money coming in from selling iPods, which was Apple's existing product. This is an example of erosion. On the other hand, Apple was probably realizing that if iPhones become a big hit, then people who love iPhones might start spending more money on buying other Apple products, like paying for songs on iTunes, buying Mac computers, and other Apple products. This is an example of the so-called synergy effect. And both the erosion and the synergy, cash flows are relevant to project calculation. In this chapter, we're actually never going to look at any numerical problems which have something so complicated going on, like the whole erosion or synergy. But it's just, so at least I won't have them on my slides. Maybe in the homework, a little example, but nothing like a full-blown net present value over multiple years, nothing of that scale. Opportunity costs are also relevant. It means foregone revenues from an alternative project. So maybe we are currently considering converting a parking lot into an office building. That's our project for which we are trying to calculate the net present value. But an alternative to that would be selling the lot and making some money. So the money that we could have instead received from selling this parking lot should be included, when we are calculating the sort of overall kind of the net initial investment into, this office building project. Net working capital, NWC, is another type of relevant cash flows. By definition, net working capital equals current assets minus current liabilities. Current assets include things like cash or other more or less small items that can be converted into cash quickly and easily, such as inventory and accounts receivable. Current liabilities include short-term loans. Short-term means needs to be paid back within 1 year. And current liabilities also include accounts payable. So the money that a firm owes to its suppliers, again within maybe a few weeks or a few months. So net working capital, as related to the whole funding the net present value for a new project, includes examples like maybe right away, if we decide to launch this project, we would need to set aside a few $100s in cash, right? Or maybe we would need to buy inventory or do something with accounts payable or accounts receivable. But just think about cash only. It's sort of the easiest thing to explain. So if we decide to set aside cash, then it's treated as an investment towards the project, right? And maybe as we start using our equipment or building, whatever assets we would need to acquire right away, as we use them more and more and more, we would need to be prepared to spend even more cash to cover any unforeseen expenses in the future. So maybe this cash reserve would need to be increased over time. And that means investing even more and more and more into this net working capital type cash flow. So net working capital, change in net working capital throughout the project's life is a relevant cash flow. Then it's probably intuitive that taxes, so paying taxes on corporate income, let's say at 34% or something like that, is also a very important cash flow, a very important expense that all firms have to face. And then things like sales revenue, costs of production, which include fixed costs and variable costs, the initial investment, then depreciation, which is needed to find how much taxes we will owe to the IRS. Then we have this term salvage value, which will come up in maybe 10-15 slides. Salvage value is essentially when the project ends, how much money do we get when we sell all our assets, like the building, equipment, etc. And all those are also relevant.